Question 1. What is the primary difference between proportional and non-proportional reinsurance? A. Proportional reinsurance involves sharing premiums and losses based on a fixed percentage, while non-proportional reinsurance focuses on providing coverage only once losses exceed a certain threshold. B. Non-proportional reinsurance involves sharing premiums and losses based on a fixed percentage, while proportional reinsurance focuses on providing coverage only once losses exceed a certain threshold. C. Reinsurance transfers all premiums to the reinsurer, while non-proportional reinsurance retains all premiums with the ceding insurer. D. Proportional reinsurance provides coverage for catastrophic events, while non-proportional reinsurance provides coverage for individual losses. Answer A. Explanation. Proportional reinsurance refers to the arrangement where the ceding insurer and the reinsurer share both premiums and losses in a fixed percentage, as stated in the reinsurance agreement. The most common forms of proportional reinsurance are quota share and surplus share. Non-proportional reinsurance, on the other hand, provides coverage only once the losses exceed a specific threshold, such as an excess of loss reinsurance. It means that for non-proportional reinsurance, the ceding insurer retains the first part of the loss, and the reinsurer only covers losses above the set amount. Question 2. Mr. Thompson, a ceding insurer, is negotiating a treaty reinsurance contract with a reinsurer. The terms of the contract include a provision where the reinsurer must cover any loss exceeding $500,000, but only up to a maximum of $2 million. Which type of reinsurance does this provision most closely align with? A. Quota share reinsurance. B. Excessive loss reinsurance. C. Surplus share reinsurance. D. Stop loss reinsurance. Answer B. Explanation. The provision described in the scenario where the reinsurer covers losses above $500,000 and up to a maximum of $2 million is characteristic of excessive loss reinsurance. This form of non-proportional reinsurance involves the reinsurer covering losses that exceed a predetermined threshold, in this case $500,000, but only up to a set limit, $2 million. This reinsurance helps the ceding insurer manage high-severity losses without involving proportional sharing of premiums and losses, which is the case in quota share or surplus share reinsurance. Question 3. In Arkansas, when a reinsurance claim dispute arises between a ceding insurer and a reinsurer, which of the following dispute resolution mechanisms is most likely to be used to resolve the issue? A. Mediation by the Arkansas Insurance Department. B. Binding arbitration as stipulated in the reinsurance contract. C. Court trial through the Arkansas state courts. D. Negotiation by an independent reinsurance auditor. Answer B. Explanation. Reinsurance contracts often include a clause that mandates binding arbitration as the primary method for dispute resolution. In Arkansas, like in many other jurisdictions, arbitration is commonly used in reinsurance disputes because it is a faster, more cost-effective alternative to traditional court trials. Mediation and court trials are less frequently used in reinsurance disputes, and while negotiation play a role in resolving minor issues, the reinsurance contract typically requires arbitration to handle significant disagreements over claims, losses, or the interpretation of contract terms. This practice aligns with standard industry practices as well as Arkansas regulatory guidelines for reinsurance transactions. Question 4. Which of the following is the key characteristic of facultative reinsurance compared to treaty reinsurance? A. Facultative reinsurance automatically applies to all policies issued by the ceding insurer. B. Facultative reinsurance involves a case-by-case evaluation of risks by the reinsurer. C. Facultative reinsurance only applies to catastrophic risks, while treaty reinsurance covers all types of risks. D. Facultative reinsurance is less flexible and requires a longer negotiation period than treaty reinsurance. Answer B. Explanation. Facultative reinsurance is a form of reinsurance where the reinsurer evaluates and accepts risks on a case-by-case basis. It applies to specific policies or risks that the ceding insurer decides to transfer. This allows the ceding insurer to have more control and flexibility in choosing which risks to reinsure. In contrast, treaty reinsurance automatically applies to all risks in a defined category or class. Reinsurer is obligated to accept the risks under the terms of the treaty. Question 5. Mr. Watson is considering reinsuring a portfolio of life insurance policies. The policies have a higher than average risk of claims due to increasing mortality rates. Which pricing method would likely be most appropriate for determining the cost of reinsurance in this case? A. Loss ratio method. B. Premium-based method. C. Risk transfer pricing. D. Expense ratio. Answer: C. Explanation. Risk transfer pricing is the most appropriate method for this scenario. Since the portfolio in question has a higher than average risk due to increasing mortality rates, the reinsurer would need to assess the risk associated with the portfolio and price the reinsurance based on the risk being transferred. This method evaluates the exposure to future claims and the likelihood of those claims being paid, which would be the consideration for a reinsurer covering a high-risk life insurance portfolio. Question 6. Which of the following is true regarding the legal framework governing reinsurance in Arkansas? A. The Arkansas Insurance Department has no involvement in regulating reinsurance transactions. B. Reinsurers must be licensed by the Arkansas Insurance Department to operate in the state. C. Arkansas does not follow the National Association of Insurance Commissioners (NAIC) guidelines for reinsurance. D. The NAIC guidelines are only applicable to primary insurers and do not affect reinsurers in Arkansas. Answer: B. Explanation. In Arkansas, reinsurers must be licensed by the Arkansas Insurance Department in order to operate within the state. The legal framework for reinsurance in Arkansas is closely aligned with the National Association of Insurance Commissioners (NAIC) guidelines, ensuring consistency and adherence to established standards. The NAIC provides model regulations, and states like Arkansas adopt them to ensure that reinsurers maintain financial stability and comply with solvency requirements. Question 7. Which of the following is an essential characteristic of quota share reinsurance? A. The reinsurer covers a specified percentage of all losses and premiums for the entire book of business. B. The reinsurer only provides coverage for individual large losses that exceed a specified limit. C. The ceding insurer retains all losses up to a specified threshold, after which the reinsurer assumes full responsibility. D. The reinsurance agreement applies to a specific risk or policy rather than the entire book of business. Answer: A. Explanation. Quota share reinsurance is a proportional form of reinsurance where the reinsurer agrees to cover a fixed percentage of the premiums and losses for the entire book of business. This means that the ceding insurer and reinsurer share both the premiums and the losses on a proportional basis. Unlike excessive loss reinsurance, where the reinsurer covers losses above a certain threshold, quota share applies to all risks included in the agreement. Question 8. Which of the following metrics is most relevant for assessing the profitability of a reinsurance company? A. Loss ratio. B. Combined ratio. C. Risk-based capital (RBC) ratio. D. Expense ratio. Answer: B. Explanation. The combined ratio is the most relevant metric for assessing the profitability of a reinsurance company. It is calculated by adding the loss ratio and the expense ratio. A combined ratio below 100% indicates that the company is making an underwriting profit, while the ratio above 100% indicates an underwriting loss. This ratio provides a comprehensive picture of the reinsurance company's overall profitability, combining both claims and operational expenses. Question 9. Mr. Lee, a ceding insurer, is concerned about potential financial instability within the reinsurance market. What type of reinsurance security can Mr. Lee require from the reinsurer to mitigate this risk? A. A fixed percentage of premiums paid in advance. B. A collateral deposit from the reinsurer to secure obligations. C. An unlimited indemnity agreement for catastrophic events. D. A clause allowing the ceding insurer to retain all claims over a certain threshold. Answer: B. Explanation. In order to mitigate the risk of financial instability, a ceding insurer can require a collateral deposit from the reinsurer to secure its obligations. This collateral serves as a safeguard in case the reinsurer is unable to meet its financial obligations, ensuring that the ceding insurer will still be able to recover claims. The collateral could be in the form of cash, a letter of credit, or other financial instruments. This is common practice in reinsurance contracts to protect against the risk of reinsurer insolvency. Question 10. Which of the following is a key difference between excessive loss reinsurance and a stop-loss reinsurance? A. Excessive loss reinsurance provides coverage for a specific loss event, while stop-loss reinsurance covers a series of smaller claims that exceed a threshold. B. Stop-loss reinsurance provides coverage for individual losses, while excessive loss reinsurance covers the cumulative losses from multiple events. C. Excessive loss reinsurance only applies to catastrophic risks, while stop-loss reinsurance applies to all types of risks. D. Stop-loss reinsurance is a proportional form of reinsurance, while excessive loss reinsurance is non-proportional. Answer A. Explanation. Excessive loss reinsurance is designed to provide coverage for a specific large loss event once the loss exceeds a certain threshold. This reinsurance is non-proportional as the reinsurer only pays for losses above a specific limit. On the other hand, stop-loss reinsurance covers the cumulative losses of a ceding insurer that exceed a certain threshold over a period of time, typically within a policy year. It is for protection against the accumulation of smaller claims, and it typically operates on a total aggregate basis. Question 11. Which of the following types of reinsurance is most likely to be used when a ceding insurer wants to share risks on a proportional basis? A. Excessive loss reinsurance. B. Quota share reinsurance. C. Stop-loss reinsurance. D. Facultative reinsurance. Answer B. Explanation. Quota share reinsurance is a form of proportional reinsurance in which both the reinsurer and ceding insurer share losses and premiums on a predetermined percentage basis. This method is used when a ceding insurer wants to share risks proportionally with the reinsurer. Question 12. Mr. Thompson, a reinsurance underwriter, is tasked with assessing a new reinsurance treaty. The ceding insurer has had a high volume of small claims over the past few years. Which reinsurance pricing method would likely be most appropriate? A. Loss ratio method. B. Premium-based method. C. Risk transfer pricing. D. Expense ratio. Answer A. Explanation. The loss ratio method is a common pricing approach when the ceding insurer has had many small claims over time. This method helps to evaluate the relationship between the premiums paid and the losses incurred, guiding the reinsurer in setting an appropriate reinsurance premium. Question 13. What is the primary role of a reinsurance broker in the reinsurance process? A. To underwrite risks on behalf of the ceding insurer. B. To negotiate the terms of reinsurance contracts between ceding insurers and reinsurers. C. To handle claims settlements on behalf of the reinsurer. D. To provide financial security for reinsurers. Answer B. Explanation. Reinsurance brokers play a crucial role in negotiating the terms and conditions of reinsurance contracts between ceding insurers and reinsurers. They act as intermediaries, helping both parties reach an agreement and ensuring that both sides understand the coverage being provided. Question 14. Which of the following best describes the reinsurance clause in a reinsurance contract? A. It outlines the payment schedule for the premiums. B. It specifies the conditions under which the reinsurer will pay claims. C. It defines the types of policies to be covered under the agreement. D. It outlines the rights and obligations of both parties involved. Answer D. Explanation. The reinsurance clause in a reinsurance contract defines the rights and obligations of both the ceding insurer and the reinsurer. It establishes the terms of the agreement, including premium payments, loss sharing, and the overall relationship between the two parties. Question 15. Which type of reinsurance is typically used for a ceding insurer to cover a large, specific loss that exceeds their retention limit? A. Surplus share reinsurance. B. Excessive loss reinsurance. C. Quota share reinsurance. D. Financial reinsurance. Answer B. Explanation. Excessive loss reinsurance is typically used to protect the ceding insurer against large, specific losses that exceed their retention limit. The reinsurer covers the losses above the agreed threshold, providing financial protection in the case of catastrophic or unforeseen large claims. Question 16. What is the primary concern when reinsuring risks related to social inflation? A. The rising costs of claims due to legal and regulatory changes. B. The increased probability of natural disasters. C. The potential for higher mortality rates in life insurance policies. D. The instability of the reinsurer's financial position. Answer A. Explanation. Social inflation refers to the rising costs of claims due to changes in the legal and regulatory environment, such as larger jury awards or expanded interpretations of liability. Reinsurers must consider this when pricing reinsurance contracts, as it can significantly increase claims costs. Question 17. Which of the following best defines risk transfer pricing in reinsurance? A. A method that sets the reinsurance premium based on the ceding insurer's overall financial performance. B. A method where the reinsurer prices coverage based on the risk they are assuming from the ceding insurer. C. A method where the reinsurer provides pricing based on historical claims experience. D. A method that determines the reinsurer's premium based on industry-wide benchmarks. Answer. B. Explanation. Risk transfer pricing involves pricing based on the actual risks being transferred from the ceding insurer to the reinsurer. This method focuses on evaluating the level of risk the reinsurer is assuming, including both historical claims and the future potential of claims. Question 18. What is the purpose of reinsurance collateral? A. To increase the reinsurer's profitability. B. To secure the financial obligations of the reinsurer in the event of claims. C. To allow the ceding insurer to share profits with the reinsurer. D. To ensure the ceding insurer does not face regulatory penalties. Answer. B. Explanation. Reinsurance collateral serves as security to ensure that the reinsurer can meet its financial obligations in the event of claims. This collateral, often in the form of cash or other financial instruments, protects the ceding insurer from the risk of reinsurer insolvency or inability to pay. Question 19. Which of the following types of reinsurance provides coverage for the aggregate losses of the ceding insurer once losses exceed a certain threshold? A. Stop-loss reinsurance. B. Quota share reinsurance. C. Facultative reinsurance. D. Excessive loss reinsurance. Answer. A. Explanation. Stop-loss reinsurance provides coverage for the ceding insurer's aggregate losses once the total losses exceed a certain threshold. It is a form of reinsurance that helps the ceding insurer manage the overall risk by covering all claims above the specified amount. Question 20. How does the loss ratio method for reinsurance pricing work? A. It uses historical loss data to predict future claims and calculate premiums. B. It calculates premiums based on the ceding insurer's operating expenses. C. It assigns premiums based on the size of the portfolio being insured. D. It sets premiums equal to the expected return on investments. Answer. A. Explanation. The loss ratio method works by using historical loss data to predict future claims and establish the appropriate premium for reinsurance. This method compares the losses incurred to the premiums paid and uses this ratio to determine how much premium should be charged to cover expected future claims. Question 21. What is the primary reason reinsurers require a claims-made reinsurance clause? A. To allow them to review claims in real time. B. To ensure claims are made within a specified period. C. To establish the amount of premium to be paid. D. To ensure that reinsurance claims are paid immediately after the event. Answer. B. Explanation. A claims-made reinsurance clause specifies that claims must be made within a certain period for the reinsurer to be obligated to provide coverage, and this helps reinsurers manage the timing of claims and ensures that they are not exposed to long-tail liabilities that could arise many years after the original policy was written. Question 22. Which of the following is true regarding the reinsurance pooling arrangements? A. Pools involve multiple reinsurers sharing a portion of the same risks with an agreement to pay claims proportionally. B. Pools are typically set up for catastrophic risks and involve a single reinsurer responsible for all claims. C. Pools are generally illegal in most states, including Arkansas. D. Pools are used only for non-proportional reinsurance agreements. Answer. A. Explanation. Reinsurance pools involve multiple reinsurers sharing a portion of the same risks with an agreement to pay claims based on their share of the pool. This is often done for high-risk events or catastrophic losses where individual reinsurers may not have the capacity to handle the entire risk alone. Question 23. Which of the following would most likely be considered a non-proportional reinsurance arrangement? A. Quota share reinsurance. B. Surplus share reinsurance. C. Excessive loss reinsurance. D. Facultative reinsurance. Answer. C. Explanation. Excessive loss reinsurance is a non-proportional reinsurance arrangement where the reinsurer is liable only for losses that exceed a certain threshold regardless of the total volume of premiums or claims. This differs from proportional reinsurance arrangements where premiums and losses are shared in a fixed ratio. Question 24. Mr. Baker, a ceding insurer, has just entered into a treaty reinsurance agreement Which of the following is a characteristic of treaty reinsurance? A. The ceding insurer negotiates individual policies with the reinsurer. B. The reinsurer must accept all risks within the scope of the treaty. C. The reinsurer only accepts risks above a specified threshold. D. The ceding insurer retains responsibility for all claims. Answer B. Explanation. Treaty reinsurance is a long-term agreement where a reinsurer must accept all risks within the scope of the treaty. Unlike facultative reinsurance, where individual risks are negotiated, treaty reinsurance covers a broad class of business and the reinsurer is obligated to accept all eligible risks. Question 25. What is a retention limit in reinsurance? A. The maximum amount of risk the ceding insurer is willing to transfer to the reinsurer. B. The minimum amount of risk that the ceding insurer must retain before reinsurance coverage applies. C. The maximum premium the ceding insurer must pay to the reinsurer. D. The amount of claims the reinsurer is obligated to pay to the ceding insurer. Answer B. Explanation. The retention limit is the amount of risk that the ceding insurer agrees to retain before the reinsurer becomes liable for the losses. It sets the threshold above which the reinsurer will provide coverage. If losses exceed this amount, the reinsurer assumes responsibility. Question 26. Which of the following reinsurance methods allows the ceding insurer to retain a portion of the risks but transfers the rest to the reinsurer? A. Facultative reinsurance. B. Quota share reinsurance. C. Surplus share reinsurance. D. Excessive loss reinsurance. Answer C. Explanation. Surplus share reinsurance allows the ceding insurer to retain a portion of the risks up to a specified amount while transferring the remaining portion to the reinsurer. The reinsurer then assumes responsibility for the surplus above the agreed retention limit. Question 27. How does a facultative reinsurance differ from treaty reinsurance? A. Facultative reinsurance covers specific risks on a case-by-case basis, while treaty reinsurance automatically covers all risks within the agreed terms. B. Facultative reinsurance applies only to individual policies, while treaty reinsurance applies to entire portfolios. C. Facultative reinsurance requires the ceding insurer to pay higher premiums than treaty reinsurance. D. Facultative reinsurance is used for low policies, while treaty reinsurance covers high-risk policies. Answer A. Explanation. Facultative reinsurance is a case-by-case arrangement where the ceding insurer selects specific risks to reinsure and the reinsurer can accept or decline each individual risk. Treaty reinsurance, on the other hand, is a broader agreement covering all risks within the scope of the treaty without the need for individual approval. Question 28. Which of the following factors would most likely influence the price of reinsurance premiums? A. The reinsurer's geographic location. B. The reinsurer's claims experience and underwriting loss ratio. C. The ceding insurer's marketing strategies. D. The reinsurer's executive compensation packages. Answer B. Explanation. The reinsurer's claims experience and underwriting loss ratio are key factors that influence the pricing of reinsurance premiums. A reinsurer with a higher loss ratio may need to raise premiums to cover future claims, while a better claims history might allow for lower premiums. Question 29. Which of the following is the primary reason for the use of treaty reinsurance over facultative reinsurance? A. Treaty reinsurance is typically less expensive than facultative reinsurance. B. Treaty reinsurance automatically applies to all risks within the treaty, saving time and effort in negotiating individual risks. C. Treaty reinsurance requires less documentation than facultative reinsurance. D. Treaty reinsurance provides better coverage for high-impact, rare events. Answer B. Explanation. Treaty reinsurance automatically applies to all risks within the scope of the treaty, which saves time and effort for the ceding insurer. Unlike facultative reinsurance, where each individual risk must be negotiated, treaty reinsurance provides broad coverage for a portfolio of risks. Question 30. In the context of reinsurance, what is cession? A. The process of determining the premiums to be paid to the reinsurer. B. The transfer of risk from the ceding insurer to the reinsurer. C. The process of settling claims with the reinsurer. D. The calculation of the profit-sharing arrangement with the reinsurer. Answer B. Explanation. A cession refers to the transfer of risk from the ceding insurer to the reinsurer. This is the core concept of reinsurance, where the ceding insurer shares part of its risk with the reinsurer to reduce the potential financial impact of large claims.